Well, hello there. Thanks for joining me. I am Dr. Jen, and it's interesting how different locations around the world have different rules. Tenancy laws are different, rules on how logistics work, tax and accounting rules are different, property rules, and just throw something else in there, who knows. Of course, for fun, all of these items can change at any time with no warning or apologies. And in the United States, there is a tool that defers capital tax liabilities. And that's a lot of $10 words in there. But sadly, in Canada, there's no such tool yet. But I've got one of the best experts I can find to talk to us today about, let's see, what is it? Defer capital tax liabilities. Here today from IPX 1031 is Sara Remley. Welcome, Sara. Hi.
Hi, thank you so much for having me. I really appreciate it. Thank you.
My
Yeah,
pleasure.
they're
Well,
little puzzles, aren't they, to put together all the time? I think that's what makes it interesting, but can also be very frustrating.
and I know my Canadian friends are like, I mean, you don't pay, you defer capital gains, you don't pay it out when you close, because in Canada, you just literally, when you get your seller adjustment sheet, it's paid out. The government gets their money first, and that's it. There's no anything that we're going to talk about today. And so, just for our listeners, tell us exactly what a 1031 exchange is.
Sure. So when we talk about a 1031 exchange, we're essentially talking about tax deferral, Jen. And we're talking about a process that allows the landlords, whether it's a little rental property on the corner, a large industrial property, to sell that investment property, defer all of the layers of taxation associated with that sale. And we'll talk about those layers. And that deferral allows the landlord or investor to reinvest 100% of their equity, not after tax equity. So if we think of this idea of leveraging all of my equity, that can be really powerful. Essentially, it's about wealth building. It's about this idea of holding on to everything I build and using it over and over again. I think of it as kicking a can down the road, if you will.
Yeah, because you still have to pay the taxes. It's not like you're getting out of it. You're just going to pay them later.
Well, and there's different tax. Are we going to talk about taxes and death right out of the gate?
We
But
could just go anywhere. Let's do it.
well, there's different exit strategies, right? So, but you're exactly right. When we think about tax deferral, this is a long-term strategy, right? I'm going to kick that can down the road. There's a little term, forgive me, we use in exchanges called swap until you drop. And it's
Mhm.
exactly what you said. Maybe I'm building wealth, I'm building a portfolio, I'm kicking my tax can down the road over and over and over again. Maybe I'm working towards the step up in basis benefit for my heirs, right? That's where my heirs get the benefit of all that work. Kicking the can allows me to build assets that are also providing me larger sources of income. So lots of benefits there. And we'll talk about conversions with primaries, but essentially it is a long-term strategy. You're right.
Yeah. Wow. Now, how on earth did you get into all this, Sarah? I mean, this is pretty complicated. How long have you been in 1031 exchanges?
It is a little complicated. My brain somehow is really good at it, and I don't know why. So, I mean, a little bit about my background. I've been doing exchanges for a little over 20 years now. I call myself a recovering broker turned tax nerd. I'm over on the dark side now. But I
That's
started my
great.
career in real estate in Hawaii. I remember doing my first little vacation rental back in the 90s and thinking this is just the best career ever. And I fell in love with everything real estate. Had my daughter, and I wanted to get out of the trenches of real estate and discovered exchanges and really just became very inspired.
Amazing.
Yeah.
Now, how many 1031 exchanges do you think you've done over the years?
Oh my gosh,
Hundreds,
hundreds and
thousands?
hundreds.
Yeah.
I remember in the early 2000s starting, we were doing reverse exchanges 20 plus years ago before they were actually in the code, with big paper files. And
Oh my
so,
gosh.
I mean, quite a while. And I love that you asked the question. It is what the code says, and we'll talk about exactly what the code says today. But really, what's interesting is that every client's scenario is unique.
Mm.
Everyone's goal is different, right? Maybe I'm not working towards this long-term strategy. Maybe I'm working towards a beautiful home for myself in the future in Hawaii again, right? And so that's what keeps it very interesting.
It's always different. That's very cool. And even though the tool may be the same, the 1031 tool is the same, the motivation is different. So let's talk,
Exactly.
I mean, the 1031 exchange, like let's say I'm gonna just a regular one. Let's just say I want to sell a home, and I want to roll this money, you can create an example. Like let's say
Okay.
I've bought a home for 200,000. It's now worth 500,000, and that $300,000 difference in equity, I potentially could be a tax liability in there. But there's this other property that I have my eye on. How do we even approach all of that, and what makes the 1031 exchanges so hard? Because I know the days matter, right?
Yeah, it's really the stress of accomplishing the task, Jen. It's not what the rules say. The rules are really straightforward. So when we talk about the essence of an exchange, right, the basic components. Now, in that example that you just gave, let's just assume that the client's basis is 200,000. Okay. In my world, a lot of times I'm talking to a client, about what is your net adjusted basis. We're going to get into the weeds of it a little bit here, but that's an important concept because if I bought that property for $200,000 20 years ago, right?
Hmm.
And I've taken 20 years of depreciation, right? And potentially not made any capital improvements. My basis is going to be much lower than $200,000. That's part of that double-edged sword. Do I want to own investment property for 20 years, or do I want to keep exchanging it and using those benefits in a proactive way, right? So,
Right.
so in the, so that's getting a little complicated, but that's an important concept. But you're exactly right. We are taxed from our basis to our gain. And when we think about that example of a basis of 200,000 and I'm selling it for five, right? If my goal is to do a fully deferred exchange, and we can talk about a partial in a minute, but if my goal is to have zero taxation, right? We start with three pretty straightforward components. One, I buy real estate equal or greater in value to what I sell. Okay. So if I'm selling for five, essentially I want to buy equal or greater to 500,000. And there's a little formula there, right? It's sales price minus commission and title and escrow become the value mark. Okay. So
Okay.
that's number one. Number two, all of my cash proceeds from that sale need to go into my replacement property purchase. Number three, nobody likes this one. It's a little bit of a brain melter. Forgive me, I'm just the messenger. It's debt replacement. And this is where a lot of clients are really confused. Jen, they call and they go, I have 300,000 in proceeds. And I go, but how much did you actually sell the house for? So we're replacing debt, right? So if we back up and I'm sorry, I'm a hand talker, Jen. So
All good. All good. Keep
so
going.
if we back up a little bit to the idea of the foundation of equal or greater in value, that includes replacing my debt on the purchase side. The way we talk about replacing debt is I'm going to have the same amount of mortgage or higher in the property I buy. If I sell for five and I buy for six, I can increase my debt, right?
Hmm.
Or I could insert my own cash to replace my debt. But the idea, if we always go back to that foundation of value for value or equal or greater in value, That being said, most exchangers are buying up in value, Jen, because I'm
Mhm.
leveraging all of my equity. So if I sell for five, I'm probably going to buy for six, or I'm going to buy two or three properties, right? I
Oh,
can
you could buy multiples. Okay.
absolutely, I can diversify my portfolio. That's a big part of the power of exchanges. So
Hmm.
I know it gets crazy. I could, I saw someone once actually sell one and buy 12.
Wow.
Yeah, so when we talk about the time frame and what I can accomplish, this can be a really powerful tool. But what stresses people out is the time frame.
So what do you mean? What time frame? What are the days? Like there's a day clock on all this, but how does it work?
Sure. So I think of it as a ticking clock, okay? And the clock in an exchange is a total of 180 days. Okay, that's to accomplish my buy. But I only have 45 days to identify. That's where all clients get very stressed out, is the idea of, well, if I sell something on October 1st, and by sell, I mean close of escrow, right?
Right.
And that starts my clock. I've only got 45 days to identify or find something to buy. I strategize a lot with clients, Jen, about how to get a head start on that ticking clock. So we start a lot of exchanges with both contracts in place because an
Hmm.
exchanger usually is not concerned about the sale side, right? They know they're going to sell the property. It's about moving money. It's about how do I accomplish the buy side that stresses them out.
Right.
And so, what I suggest is, once you get the property you're selling in escrow, through those initial contingency periods, leverage your power as an investor. Most investors doing exchanges are cash buyers or cash rich buyers, Shan. So I can leverage and say, hey, I'm going to write a contingent offer on what I'm going to buy and close 48 hours after my sell. Use that power to get ahead of that ticking clock. But that's always the question, is I'm worried about identifying. And I say, get a head start.
Well, especially if you can get the property that you want to buy under contract, like you say, you've got both contracts, the contract that of the property you're selling, you're going to use the proceeds to buy the one that you're buying. Now, let's talk about property types because there's a lot of confusion with people saying, I'm going to sell either a rental or my home, but I want to buy a vacant piece of property that's worth more. And then I want to build, or I want to buy a commercial building, maybe, or like everybody's saying, oh, but it has to be a house for a house. I mean, is that true?
I love that you asked that question. No, that's not true. And that is probably the biggest myth in 1031 exchanges. And it's been the biggest myth since I started 20 plus years ago, Jen. I every single week, I will have at least two calls asking me that question. And I remember when I was a fresh agent, I'm using the word fresh nowadays. And I was selling real estate on the Big Island in Kona, and I remember learning like kind. And I thought in my mind, oh, so easy. That means single family home for a single family home. And that is not true. And we have to
Okay.
remember this is a term created by the IRS. Okay. And this
Okay.
and what it means is real property held for investment purposes for any other real property held for investment purposes. So what that means is I can sell a single family home and I could buy a commercial property, right? I could sell land and buy an income producing property. So the idea of diversification, selling one and buying two or three, I could consolidate. I could sell two or three different types of real estate and consolidate that into a larger singular purchase. It's about the intent. And that's what's important when we talk about exchanges, not the property type. Um, in
Okay.
the example you gave, so I used an example of land to an income producing property.
Okay.
A lot of investors, we're all sitting on a lot of equity, right? Which is a double-edged sword out in real estate right now,
Right.
right? A lot of investors that have held land for a long time don't know that they can exchange that for an income producing property because of that foundational misinformation, right?
Okay.
In the example you gave of selling an income producing property, maybe to buy land, yes, I can do that, but we go back to that idea of my depreciation recapture.
Oh
It's
yeah.
so technical. My depreciation recapture is part of my layer of taxation on the rental property I sold. So in exchange into land, we want to make sure that that client is consulting with their CPA to make sure that's a fully deferred process for them.
Right.
Yeah.
Well, one of the reasons I wanted to have you on, Sarah, I mean, you and actually, Mike, my husband, called you because we were talking about buying something and then potentially selling something to support the purchase. And
Yes.
so this term of a reverse 1031 exchange came up and sort of blew my mind. And then that's when you and I started talking. I said, I have to have you on the show. So let's
I,
go there.
uh,
What on earth is a reverse 1031 exchange?
Sure. So I fondly call that the deep end of the pool, Jen, right? When we think about exchange strategies, and it's very interesting to me, a lot of landlords that listen to you, they may have only learned that foundational value for value, 45, 180, right? And
Right.
never expanded their knowledge base. And when I think about exchanges, I kind of think of a scale of complexity, if you will, right? We start down here with this foundational idea of a forward exchange that we're talking about. I sell real estate, I have my ticking clock, and I buy real estate, right?
Okay. Yep.
The reverse exchange, I call it the problem solver. When you mentioned why exchanges are hard, and I said, well, people get stressed out about the time frame and moving money, right? It's this idea of, oh my gosh, what do I buy? The reverse exchange is a process where we're flipping that whole thing on its head and allowing you as the investor to buy the replacement property as step number one. Yeah. Do you want me to, I can get into, we
Keep
can go into
going.
the,
This is,
okay.
yeah, no, keep going. This is exactly what we want to hear.
Okay, awesome.
It's
So,
crazy.
it is, and I'm so grateful again that you have me. I'm gonna say people call me. This is everybody's scenario is very unique. But so when we talk about a reverse exchange, there's a foundation in 1031 exchanges where you as the client, as the taxpayer, we use the word taxpayer a lot. You cannot hold title simultaneously to the property you're selling and the property you're buying. So if we're talking about a reverse exchange, we're talking about you buying a property as step number one, right?
Right.
So what we do, and all of these processes, you have to use the intermediary, right? The qualified intermediary, the facilitator. The IRS requires the neutral third party, regardless of the process being used. And the reason I say that, Jen, is that sometimes I present this and somebody goes and they go, I got this. And they go do it on their own, and that's not how it works. And the
Mm,
reason for that is we're going to disconnect the taxpayer from the title on the buy side. So we
mm,
create an LLC. Think of it as like a special purpose entity. We call it an exchange accommodation title holder. Okay. We're creating an LLC where IPX 1031 is the member. The client is going to be the manager. Okay. You're still going to be
okay.
signing documents. Okay. And that LLC is going to be inserted at the close of escrow as the actual buyer. Okay. So if we think of the mechanics of that, you're going to write the contract to buy something. You would hire the intermediary. The intermediary creates the LLC and then inserts that at the escrow level as the actual title holder. We haven't talked about the money yet, though. That process obviously works easiest if the client has the money to buy up front, right? If they have the cash, I should say, to clarify up front. So if I'm going to buy first and I'm going to buy something for $500,000, for example, let's use that same little maybe rental property on the corner we have going, right? I'm going to need that $500,000 available out of my own pocket to accomplish that purchase, right? That's where people go, where am I going to get the money? It doesn't matter to us where you get the money. You could borrow
Right.
it from a friend, you could borrow it from a family member. Some people take equity on a primary home or another asset they might have. We're just talking about accomplishing this purchase, right? It's very complicated when we try to involve a lender in this because they obviously don't like that disconnect, right, on the title.
Well,
So
an IPX 1031 would be the owner, right? I wouldn't be
exactly,
the owner. So it's,
ex
yeah, it's weird. This is crazy.
exactly right. Now that being said, though, Jen, you've hit it on the head. Now that's why borrowers now that you can do a bridge loan. There are lenders that will work with this process. It's not going to be a Bank of America. It's not going
No,
to be a Wells Fargo. You're
right,
not going to find a big box lender who's going to be like, sure, let's go. And so, because if we go down that process further, I love what you just said because now we've closed escrow. IPX is the title holder of the property. But this is your property, right? You've put out the
right,
money to buy. So we immediate this is complicated legal stuff we're talking about, Jen. I'm
right.
I'm
Of
giving an
course.
overview, but
It's
so
okay.
we're going to triple net lease the property back to you at no cost, right? So you have the immediate economic benefit of the replacement property, right? As step number one. So you've solved the issue of what do I buy? So the triple
Right.
net lease, zero cost. You're renting that property, you're collecting income from that property, right? And then if we think about that ticking clock now started at the buy side. And this
Hmm.
is what's so powerful. Now you have 45 days to identify, right? And 180 days to sell. So that's a much easier type of exchange. It's more expensive, it's more complicated,
Yeah.
but
Well,
it
it's
solves the problem.
interesting. I mean, when we were talking with one of our mentors about a reverse 1031 exchange, and he just sort of stopped and went, what are you talking about? And I said, if you've never heard of this, and he's done lots of multifamily deals and has lots of
Sure,
rental tours and things,
sure.
and he had never heard of this. And I went, this, and so even this is exactly why Mike was looking for you, was because we wanted to learn how this worked. And
Hmm.
particularly, we wanted to figure out how on earth would we first buy what we want to buy. How would we do this? How would the lender look at this? It does complicate it if we're trying to get a lender, but I'm sure there are lenders out there that would bridge. I'm sure there are.
Absolutely. Yeah, no, we have very specific non-recourse language with that we want
Yeah,
that lender to include, right?
yeah.
We're sharing some liability there. And the thing, so IPX, we're it's gonna sound a little braggy, we're the gold standard. We are a wholly owned subsidiary of Fidelity National Financial. When it comes to security and doing it the right way, that's our number one concern, Jen. And
Hmm.
so when we talk about these processes that are very complex, it's this idea of you've got to hire someone that knows how to do it the right way, right? And
Yeah,
because there's a lot of liability here. But we do, oh my gosh, over 100 of these a month.
a month.
Yeah, I mean,
That's a lot.
they're a very
That's like three or
popular
four a
strategy.
day.
Yeah.
I might do one in my whole lifetime,
We-
right?
We've got an entire department full of attorneys that specialize
Mhm.
in these very complex type of structures. So yeah, yeah. And I love that you're spreading the word.
Well, it just if it intrigues me and Mike and it makes us think and
Yeah,
other people don't seem to know about it, then it's like, okay, that let's get this out on the podcast. Let's get this out. Let's talk about it. And then the community will ask more questions and there'll be more follow-up. There'll just be more chatter in general because there's a lot of confusion about this vehicle. whether we're
Oh
talking
my
forward or
gosh.
reverse 1031
Yes.
exchanges.
Yeah, I'll do a consultation on like a Friday afternoon, Jen, and I'll say to the client, now don't even mention that you're doing a 1031 exchange when you go to a dinner party on Saturday night. Because there's so much misinformation, there's so much confusion. We're talking about this idea of layering, tax code, real estate transactions. This gets very complicated. And I mean, just to open that door a little further, we do combinations of these exchanges, right? If we think about the idea of, I get a lot of calls from investors, from landlords who say, gosh, I have these two little single family homes and I want to sell them and I want to exchange them and I want to buy a fourplex, for example, right?
Okay.
Well, when we think about this idea of the ticking clock, well, the ticking clock starts with the sale of the first two properties that you're selling. So
Hmm.
you have to have a very proactive strategy if I'm going to sell two properties and get them to close within a 45-day window of each other versus maybe I can sell one and I've got my eye on the fourplex. Now I only have to come up with half the cash out of my pocket. I can do a forward on part of the purchase and a reverse on part of the purchase. I know, I'm sorry.
Oh my
And
gosh.
then when I sell, I'm getting reimbursed. That money flows back to me. I think of it as a
Holy
circle,
cow.
Jen. I'm sorry.
Oh,
It's so interesting though,
it
isn't it?
is.
There's so many solutions.
Well, and you know all the tools super well. You mentioned something, and this is where I am always looking at it because I do all our books on the US and the Canadian side. I do all the QuickBooks, I do it all, and I have help, but I do primarily most of it. And I'm looking at this going, what are the costs? Because
Right.
right? When we're doing a transaction, whether I'm doing a forward 1031 exchange, now I have to have a 1031 exchange officer. Like it's a different type of escrow, and we have an escrow, and like there's a bunch of different things involved. How much does all this cost?
Sure. So let me clarify. You're going to do
Yeah.
escrow like you normally would.
Okay.
We were considered a neutral third party. The way I like to describe it, Jen, is that we work at the escrow level. Okay. So you don't need
Okay.
now. There is a different kind of reverse where we can park a relinquished property. Then we get complicated on two escrows. But for now, let's just we'll stay.
It
I've
gets more
I've got all
complicated.
kinds of
Oh my God.
solutions. But you don't have to, and also an exchange company works like your realtor. We don't get paid until after the closing of that transaction. So you're not jostling money to an exchange company first. So with IPX, my exchanges here, they're $1,000. That's selling one and buying one. We are a volume business. When we get into this idea of very complex type of exchanges, that price can be 6 to 10 times more. And the reason I'm giving a range, I know, is because properties that are over 3 million and up to 20 million, we're going to have a different scale because we are taking on some of that shared liability, for example, with the property. That being said, I really, part of my conversation with a client, we really start with this idea of where you and I started. What's your basis? What kind of gain are you looking at? If a client calls me and their gain is $50,000, I'm not probably going to suggest a reverse exchange as a solution because it's so complicated, right? Sometimes people will do a little research. Thank you, AI. And they'll call me and they say, what about this reverse thing? And then I go, well, let's talk about the numbers. Does it make sense for you? But
Right.
this idea of we're all sitting on so much equity, now the value of the reverse exchange is very much there, right? Because if my taxable gain, we go back to the example you and I were using in the beginning, if I have a taxable gain of $300,000, it's going to be worth it to me to spend $7,000 as a solution.
Right.
Right. And by the way, I work with a lot of Canadian investors. So
Oh, good.
foreign investors, yeah, I love that you said that. I wanted to circle back to that. So, if you're a foreign investor and you're subject to FERPTA withholding in the US and you have rental property, you can do a 1031 exchange here as well, right?
Wow.
We circle back to that value for value idea, Jen. If I let's say I am a Canadian, a nice Canadian, and I'm subject to 15% withholding by the US government, but
Mhm.
I'm doing value for value. I just need to have the cash to insert on my buy side. Withholding is just withholding, kind of like a Jerry Maguire, show me the money, right? And then you file and so but absolutely don't hesitate. We work with I'm so sorry, a lot of foreign investors in the US. And you can take advantage of 1031 exchanges as well.
Sarah, I had one other question
Just
that
one?
well,
I'm kidding.
no, there's lots more, but one on my list at the moment. But the biggest one is that I keep hearing this term double dip. And I'm thinking it has to do with selling your primary residence, and then there's some kind of a tax benefit, and then you throw it in a 1031 exchange, and it's like you get credits in here. Like, is that a good thing? I mean, I don't know.
Sure. I love that you mentioned, I should have trademarked that term double dip. I think someone stole it from me. But yes, absolutely. So let's go when in the beginning, when you and I were talking about this being, when I said swap until you drop.
Yeah.
Okay, and forgive me, guys. Okay. But maybe my idea is to buy something that's a future primary home for myself, right?
Okay.
So, but let me go back. I was gonna go down kind of a 4-year path, but let's talk about
Sure.
the double dip. So when we think about real estate and we think about tax code, the reported use of real estate, Jen, is what attaches it to certain sections of the code. So if I'm a landlord and I have a rental property on the corner, my reported use to the IRS, hey, here's my rental property, here's my income, here's my expenses, right?
Okay.
My primary home, I'm reporting the use of my primary home to the IRS as my primary residence, right?
Mhm.
This is my primary home. This is where I live full time, right?
Right.
I often use an example. So I grew up in San Francisco. And I use an example. I know I should have bought more real estate, but I use an example of I have girlfriends back in the day that bought property in San Mateo for $300,000 30 years ago.
That's a
Okay.
lot of money then.
It was. And I remember we used to tease each other about like, you're buying that old 3-2 ranch. Well, now that house is worth $3 million.
Million.
So if we think about that scenario, if I'm sitting in a primary home, and after all that time, my basis is probably nothing. Let's just say it's zero. Okay. And this is
Okay.
a very common problem.
Yeah.
Um, if I'm sitting on a primary home and it's worth $3 million and my basis is zero, and I'm in the state of California, my only exemption, and let's say I have an imaginary husband, okay, he's sorry, guys. And my exemption is $500,000 as a married couple, right? That's the
Right.
121 exemption, $500,000 exemption on taxable gain if you've lived there full time 2 out of 5 years, right? That 5-year
Right.
window is important. I can actually move out of my primary home and rent it for 2 years, Jen.
Mhm.
Okay. So I move out, I still have a 5-year window. Okay. So I've moved out, I rented it for 2 years. I've established my use of the home as a primary or as an investment property, right? But I
Mhm.
still have my 121 benefit attached to that property because the 121 benefit says I had to have lived there full time 2 out of the last 5 years as my primary residence. So still with me, right? We're in a 5 year
Mhm.
window. I
Yeah.
essentially have lived there for 3. I've rented it for 2. Now, when I sell that property, it's exactly what you said. I get both benefits. I'm taking my exemption. I'm still claiming my exemption of 500,000 at the sale. And
Hmm.
now, because I rented it for 2 years, that 2.5 million in taxable gain over the exemption, I can put that into a 1031 exchange.
Mm.
And that's so powerful. I just exited the state of California with zero tax and a high gain property. And what a lot of investors, when we talk about long term, Jen, what some of them do is maybe 2 years before that, I sold my investment property in California and I exchanged out of California and I bought something that's going to be my future primary home. Okay. So 1031s are investment property for investment property. I'm selling a rental and I'm buying a rental. But I can buy a rental and I can convert the use in the future into a primary home. So that could be my exit strategy. And so
Ah.
maybe I sell 2 little rentals and I buy a beautiful home that I'm going to move into 2 years in the future. The code is super specific, no less than 2 years. And now I convert it to a primary. And then at the 5 year mark, I've actually reestablished my 121 exemption. So
Think
very
again.
powerful strategies, Jen. When we think about maybe I don't want to swap until I drop. Maybe I don't have heirs, right? Some
Right.
people don't like their heirs. They tell me I'm not working for my kids. I know. So a lot of different ideas about how to utilize 1031 exchanges to accomplish those personal long-term goals.
I've seen 1031 exchanges used in even things like estate planning. And
Oh,
there
yeah,
was a really interesting example brought up, and I just want to voice it so people are aware
yeah,
this stuff exists. And I'm sure you've worked on it. But there's a couple. Their house had um, really gone up in value, and they have
hmm,
4 children, 4 grown
yep,
children, and they all have their own families, right? And they're
yeah,
all over the place, and they're not where they grew up. So the parents said, "Hey, kids, all 4 of you, go pick out a house worth about X amount of dollars that
yeah,
you will want to live in at some point,
yep.
and we're going to buy it." And so the parents sell the house, they 1031 exchange into 4 other houses that then they basically shifted the capital gains to them. And then when the parents pass away, the 4 houses they transfer title. Have you seen that done? Because that sounds amazing.
Many, many times, and it's
Oh,
so powerful. And
yeah.
that really speaks to my heart when we talk about this idea of generational wealth and how do we pass on generational wealth. That is such a fantastic strategy because, yes, I passed on generational wealth, but my child got to pick out the property, right?
They picked
And,
it
and
out.
and there's another layer to that where that child can even be managing that property for me, right? We can bring them into the fold, if you will. So all of that responsibility isn't on my shoulders.
Right.
Absolutely. It's a big part of what people use because every child's goal is different. You're exactly right. They're in different areas geographically.
Yeah.
Sure. Yeah,
Yeah.
very
Very
popular.
cool.
The other thing I would love to touch on, I think it's important just to know how dynamic, when we talk about like kind, right? There are actually now financial products that qualify as 1031 exchange replacement properties. I can't remember
Okay.
in our initial conversation if you and I talked about Delaware statutory trust properties or
Hmm.
DST properties. I don't recall if we touched on that before.
I don't think so. I know what they are, but
Yeah.
yeah, no.
Well, and they're very, very popular with exchangers right now because if we think about a baby boomer, right? Maybe they're 85 years old and this is a very typical exchange that I'm seeing right now, right? And maybe they have an industrial property that's worth $3 million.
Okay.
Don't want to be a landlord anymore. They're looking for this idea of, well, I need the tax benefits. We do reach a point in life, by the way, where we cannot divest out. It becomes detrimental to our larger financial picture to just say, I think I'll sell and not be a landlord, right?
Right. Right.
So when we think about the DST as a 1031 exchange, a security sold as real estate, it's deeded real property, that fractional interest. That's how it qualifies as like kind. But I could sell my industrial property and buy 3 or 4 separate interests of DSTs, full tax benefits with passive income, right?
Hmm.
The
Okay.
other advantage of a DST is maybe I have debt. So we talked about value for value, right? If I have debt on the property I'm selling and I'm not able to replace the debt, I have the potential of using a DST as the replacement property, and that sponsor could assign me a portion of their debt. So
Hmm.
I'm removing debt from my personal portfolio, getting the tax benefit and passive income. A DST is different than a REIT, though. I want to clarify that. Yeah.
Interesting. Really
Yeah.
interesting.
Lots of
Super
solutions.
technical.
I'm
Yeah.
sorry.
No, no, no,
Yeah.
don't be sorry.
Yeah.
This is exactly why I wanted to have you on the show, is because it gets so it's a little bit confusing,
Yeah.
and it can get, and this is why it gets really stressful. And there are ways to hedge that anxiety depending on what the ultimate goal is. And that's exactly what you've spoken about, Sarah. And you've really opened the toolbox here and explained, there's lots of different ways, but it depends on what the ultimate goal is. What
Knowledge is power, right?
Yeah.
It's how we get there and what the solutions are and combining some of these ideas, right?
Yeah.
I teach a lot of classes to agents, and I tell them all about 20 minutes in, I say, just call me. Just call me, because we talk about vesting, this continuity of taxpayer from the seller to the buyer. There's all these layers, Jen.
Yeah.
Absolutely.
And everybody's situation is very likely different. And even if they're exactly the same, maybe their tax basis is different, or baseline is
Yes,
different, or whatever. I mean, it really is very unique every single time. Well, Sarah, I'm
absolutely.
so glad you've been on the show. Any parting thoughts?
Oh gosh, other than call me, I'm trying to see where my
Yeah.
number is. Call me.
Okay, so
No, I love that. And just a reminder, my name's Sara Remley. I'm with IPX 1031 Exchange. I'm an account executive. I'm a free resource, Jen. I encourage people, if they have questions about an exchange, reach out and call me. Get real information.
sure.
And then kind of, and we'll have the full discussion.
I
So yeah.
love it.
The other thing I would say is just keep in mind, everybody, that if you're going to do an exchange, it has to be in place before the close of escrow. I get a lot of regret calls, Jen, so that would be my 2 cents, is call me before you sign the closing statement.
Oh man. And then of course, then there's a big bill from the IRS with that too. And
Exactly.
there's no way you can avoid it because you haven't done it right. My goodness. Well, Sarah,
Exactly.
pleasure to have you on the show. For those of you who are listening, if you're not watching on YouTube, her phone number is 702-232-4576. And it's Sarah from IPX 1031. Thank you so much for being here today, Sarah.
My pleasure.